Ever feel like you're drowning in financial reports just trying to get a handle on how a company's really doing?
Yeah, it can be like trying to find a needle in a haystack, right? So much information, but what's the important stuff?
Exactly, and that's why we do these deep dives. We take these dense documents and we try to pull out the key takeaways for you.
Today, we're looking at KEI Industries.
You send us their Q2FY25 earnings conference call transcript. We want to really understand how they're performing.
Yeah, what are their growth drivers? What's their outlook? What risks are they facing? All that good stuff.
So first things first, let's break down KEI Industries' different business segments, see how each of them is doing.
Sounds good. Let's start with the second quarter results, shall we?
Perfect. Overall, they reported net sales of INR 2,279.64 crores. That's a pretty solid 17.21% growth year over year.
Not bad at all. And what about their profitability?
Their EBITDA for the quarter was INR 237.52 crores, which translates to a margin of 10.42%. Their profit after tax, or PAT, came in at INR 154.81 crores.
Okay, so a pretty decent quarter overall, but now let's zoom in and look at the individual pieces, starting with their domestic institutional cable sales.
Those grew by 20%, reaching INR 615 crores.
Impressive, but hold on. Didn't their extra high voltage EHV cable sales actually decline?
Yeah, you're right. EHV sales were down to INR 73 crores from INR 169 crores in the same quarter last year.
Interesting. What's the story there?
Well, they actually explained that in the call. They said they shifted some of their EHV production capacity to manufacture medium and high voltage power cables.
So maybe they're seeing stronger demand or better margins in those other categories.
It seems like it, and it's a good reminder that not every decrease in sales is necessarily a bad thing. It could be a strategic move.
Absolutely. Now, let's talk about their dealer network sales, their B2C business.
That segment saw huge growth, hitting INR 1,258 crores. That's a whopping 36% increase.
Wow, that's a significant jump. It seems like their retail operations are really thriving.
It's a major factor driving their overall growth. In fact, their B2C sales now account for 55% of total sales, up from 47% last year.
So they're becoming more and more reliant on that retail segment. What about their engineering, procurement, and construction, or EPC sales, excluding cables?
EPC sales were down to INR 80 crores from INR 113 crores.
I see. And within that, their EHV EPC also decreased slightly.
Yeah, it seems they're deliberately trying to reduce their exposure to the EPC segment because of its inherent volatility.
That's a pretty common strategy. EPC projects can be risky and unpredictable. What about their exports?
Exports saw a minor decrease, coming in at INR 241 crores, down a bit from INR 249 crores.
Okay. And stainless steel wire sales?
Those remained pretty stable.
All right, so to recap, KEI Industries had a solid second quarter, driven largely by that booming retail segment.
The growth in B2C sales really offset the decline in their institutional and EPC sales.
Right. Now, let's broaden our view and look at the first half of the financial year, 2025.
Their net sales for the first half reached INR 4,340 crores. That's a 16.5% increase year over year, so still a good pace of growth.
And profitability.
EBITDA grew by 18% to INR 469.93 crores, giving them a healthy margin of 10.83%. Their PAT rose by 16.62% to INR 305 crores with a margin of 7.03%.
Okay, consistent profitability. Let's see how the individual segments performed during this first half. What about domestic institutional cable sales?
They saw a 19% increase, reaching INR 1,189 crores, but once again, EHV sales were lower.
Interesting. So this trend of lower EHV sales is continuing?
It is. They came in at INR 152 crores, down from INR 218 crores in the previous year's first half.
Same explanation, I presume.
Yep, they're prioritizing the production of medium and high voltage cables over EHV cables. Now on to the star performer, the dealer network.
Let's hear it.
It continued its strong run, reaching INR 2,343 crores in the first half. That's approximately 33% growth.
Fantastic. I'm really starting to see why they're focusing on that retail side.
They now have around 2,038 active dealers, giving them a wide reach across the country. And BDC contributed 54% to total sales of the first half.
That's up from 47% last year. It's a pretty clear shift in their business mix.
It is. Exports for the first half were INR 474 crores, and overall institutional sales remained at 39% of total sales.
Okay, so a consistent story emerging there. Now, what's interesting is they also shared the volume increase in their cable division.
Right. Based on the amount of metal they used, the volume increase was about 14% for the first half.
That gives us a tangible sense of the real growth in their core cable manufacturing business. Now, let's shift gears and talk about their outlook for the future.
They seem pretty optimistic about the demand for their products. They have a huge pending order book.
How big are we talking?
As of October 13, 2024, their order book stood at a massive INR 3,847 crores.
That's a lot of future business. Where's all that demand coming from?
It's spread across various segments: INR 603 crores for EPC projects, INR 301 crores for EHV cables, INR 2,368 crores for domestic cables, and INR 575 crores for exports.
Okay, so pretty diverse demand across their different business lines.
And they also mentioned being the lowest bidder, or L1, for an additional IR 186 cores order for EHV cables from Tata Power.
All right, so that order book is looking pretty healthy. And what are the key sectors driving this demand, according to KEI Industries?
They highlighted the renewable energy sector, particularly solar and wind, as a major growth driver.
That makes sense. It's a booming sector globally.
They also mentioned the power transmission industry. The government has a big plan to invest INR 9 lakh crores in this sector.
That's a huge investment. It's no surprise that KEI Industries is looking to capitalize on that.
They also see opportunities in thermal power and pump storage projects.
So basically the whole gamut of power generation and transmission. What else?
They mentioned highways and railway tunneling projects. Lots of infrastructure development happening in India.
Right, and those projects need a lot of cables.
And they also highlighted data centers as a growth area. More and more data centers are being built, and they all need high-quality cables.
It seems like KEI Industries is well positioned to benefit from these broad industry trends. But what about the potential for a post-election slowdown?
Someone actually asked about that during the earnings call. The management acknowledged it's a possibility, but said their strong order book and their presence across multiple sectors mitigate that risk.
Diversification is key. By not being overly reliant on any one sector, they're more resilient to economic fluctuations.
Absolutely. They did say their primary focus is on the energy sector, although it's tough to give a precise breakdown of their revenue by sector because of their sales through dealers and EPC contractors.
Okay, makes sense. Now let's talk about their expansion plans. They've been quite busy on that front.
They have. They completed expansions at their Chinchpada and Paterdi facilities during the first half of this financial year.
So these are brownfield expansions, right? Expanding existing facilities.
Correct. These expansions will primarily boost their production of wires and power cables.
And these increased capacities are expected to contribute to their growth this year.
They are. They're projecting 16-17% growth in the current fiscal year, partly thanks to these expansions.
That's substantial, but they're not stopping there, are they?
Not at all. They have a major greenfield expansion underway in Sanand, Gujarat. They're building a brand new plant there.
Okay, tell me more about that.
It's a huge project. The total planned capex for the Sanand plant is between INR 900 to 1,000 crores.
That's a big investment. What will they be manufacturing at this new plant?
It'll be a major hub for them, producing LT, HT, and EHV cables.
So pretty much their entire range of cables. When do they expect to start production?
They're aiming for commercial production to begin by Q1 of FY 2026-27. They plan to invest another INR 600 crores in the following financial year to fully complete the project.
Wow, they're really going all in on this expansion. What kind of revenue are they expecting from the Sanand plant?
They're projecting a capacity of around INR 5,000 crores in revenue.
That's massive. And how does that break down across the different types of cables?
They estimate EHV cables could generate INR 1,200 to 1,300 crores, HT cables potentially INR 1,500 crores, and possibly up to INR 3,000 crores because of flexibility between HT and EHV production.
I see. So a lot of potential there. And what about their long-term growth targets?
They're aiming for a CAGR of 15-16%.
So they're expecting to sustain this high growth rate for years to come.
That's the plan. And their expansion ambitions go even further. They've set aside INR 500-700 crores annually for capex beyond the Sanand project.
They're really serious about growth, aren't they?
They are. They mentioned a potential new facility on land they've acquired in Baroda for manufacturing low and medium voltage cables. It seems like there's no stopping them.
Okay, impressive expansion plans, but let's not forget about the risks. What are some of the challenges KEI Industries might face?
A key one is the volatility in copper and aluminum prices. These are essential raw materials for cable manufacturing, so price swings can impact their margins.
Right, but they did mention that these price fluctuations tend to average out over longer periods, right?
Yeah, they said they're more concerned about the short-term impact quarter to quarter. Their first half margins were healthy.
Okay, so they can manage that volatility to some extent. What other challenges did they highlight?
They mentioned potential delays in executing their EHV cable orders.
I see. What causes those delays?
Things like right-of-way issues, regulatory clearances, those kinds of external factors that can be unpredictable.
Yeah, those can definitely throw a wrench in the works. It can make their EHV sales lumpy.
It can, but the management expects these issues to smooth out over the full financial year.
All right, so a short-term challenge, potentially. What about their financials? Anything to note there?
They did mention that their finance costs increased in the first half of FY25 to INR 27.49 crores, from INR 16.47 crores last year.
Why the increase?
Partly due to higher borrowings and increased reliance on creditor payments.
And this brings us to their interesting decision to go for a QIP.
Right, a qualified institutional placement to raise additional capital.
It seems a bit counterintuitive, right? They have positive cash flow. Why raise more money?
Their goal is to stay debt-free, even with a huge capex plan for the Sanan project.
So it's about strategically managing their debt levels and ensuring they have enough working capital to fuel their growth.
Exactly. They want to avoid taking on too much debt and incurring high interest costs.
It's a long-term approach. They're thinking beyond the current financial year, making sure they have the resources to keep growing.
Absolutely. And finally, they addressed the expected lower asset turnover rate for the Sanan plant.
They're projecting around 2.5 times compared to 3.5 times for their existing operations. Why is that?
It's mainly because of the significant upfront investment needed for infrastructure and specialized equipment for EHV cable manufacturing at the new plant.
It makes sense. These large-scale investments take time to generate their full revenue potential.
All right, so let's wrap this up with the key takeaways for our listeners.
Sure. KEI Industries is demonstrating strong overall growth, particularly driven by their retail segment.
They've got ambitious expansion plans in place, especially with that massive Sanan plant coming up, and they're seeing robust demand across various sectors, especially energy and infrastructure.
They are facing some short-term pressures, such as raw material price volatility and those EHV execution challenges, but their strong order book and their commitment to long-term debt-free growth paint a positive picture for the future.
This deep dive gives you a good overview, but there's even more detail in the full analyst call transcript. We encourage you to check it out if you want to dig deeper.
And here's a final thought for you to ponder. Given their significant investment in the Sanan plant and their focus on remaining debt-free, how might this capital allocation strategy impact their future profitability and shareholder returns? It's a complex interplay of factors that's worth considering.
It definitely is. And that's all the time we have for today. Stay tuned for our next deep dive where we'll explore another interesting set of source materials.
We'll see you then.
Bye for now.
Bye.